morning, friends. Good morning, friends. Hope you're all doing great. Today we shall be doing the last topic of our corporation tax, which is with respect to group of companies. Now it's definitely a very practical scenario wherein you have a holding company, that is a parent company, and you have a lot of subsidiary companies forming part of a group. So how do we deal with corporation tax when the company is forming part of a group? What are the various relief forms that a group company can avail? What forms a group in the first place? So we'll be doing all the rules with respect to group of companies for corporation tax point of view. So without wasting any time, let's get on to the rules of the topic first. So now what is a taxable entity in its own self? Now a group of companies wherein you have a parent company and you have subsidiary companies, definitely each of these companies is a separate legal taxable entity in its own right. So all of them are assessees, taxable entities in their own right. When they form part of a group, what sort of rules are applicable with respect to the group of companies that they are forming? So let's have a look at what are the taxable rights of these companies and what is a gains group to start off with. The first thing that we need to know, let me quickly grab my pen. All right. So each company in a group of companies is a separate taxable entity with a separate corporation tax computation required for each company. So each company is a separate taxable entity in its own right, has its own, it's going to finalize its own set of accounts as well. However, where companies belong to a group of companies under the common ownership, so which means that you have a common parent or a holding company and you have other subsidiary companies, losses may be relieved on a group-wide basis where the group is a 75% group. So in order to relieve your losses, you need to form part of a group which is known as the 75% group. So we'll be doing what is a 75% group to start off with, to understand wherein companies can relieve their losses against each other. Also, the taxation of capital gains may be reduced and the capital loss relief made easier where the company forms part of a gains group. So now apart from a 75% group, we will also be doing a terminology which is known as a gains group. So two things we have to learn as of now. What is a 75% group and what is a gains group, and what are the repercussions of being part of each of these two different types of groups, 75% group and gains group. Now let's start first with the 75% group. So you can relieve your losses in the form of reliefs, in the form of a group relief when you're forming part of a 75% group. Now what is this 75% group first? Let's try and understand by the terms of a definition of what would be defined under a 75% group. So a 75% group comprises a parent company. So what do you have? You have one parent company and its 75% subsidiaries. Any of the companies may be a UK or a foreign resident company. So in order to form part of a 75% group, any company, any parent company and any of its subsidiaries, as long as the ownership is 75% of the holding, forms part of the 75% group. Now, in each of these entities may be UK resident or may be a foreign resident company. A 75% subsidiary is one in which a parent company owns directly or indirectly at least 75% of the ordinary shares, is entitled to at least again 75% of the distributable profits and assets of that company on the winding up of the company. Although a 75% group may comprise both UK as well as foreign resident companies, a non-UK resident company is generally not allowed to relieve a loss of its own against profits of its fellow UK resident group companies. So very simply, what do we have? Let me pen down for you. So we are talking about a 75% group company. So very simply, what do we have? We have a holding company, or let's call it a parent company, which owns at least 75% of the subsidiary companies, right? So let's S1, S2, S3. So what are these? Now the holding company is holding at least 75% of the holding of the subsidiaries, known as the 75% group, which forms part of H, S1, S2 and S3 forms part of the 75% group, as long as the ownership of the assets is at least 75% upon winding up, as well as at least owns 75% of the ordinary share capital of the company. So to form part of a 75% gains group. Also, now what are the effects of having these fellow companies? So similarly, we are obviously able to relieve the losses of any of these companies amongst the group members. So what you can do, you can relieve losses. However, if any of these companies, let's take for example, S2 is not a UK resident company, which means it's a foreign resident company, then definitely S2, even though it forms part of the 75% group, would not be allowed to participate in the loss relief, which means that any losses of S2 cannot be set off against the profits of the UK resident other companies in the group. So any company which is a non-UK resident, which means it's a foreign resident company, would not be able to participate in the group relief. So any non-UK company, or what I call it, either foreign resident company, does not participate in the, group relief. It does form part of the group, but it cannot participate in the group relief. Very simply, why? Because UK HMRC will not allow its profits to be reduced by a subsidiary in the foreign location which is making a loss. Why? Because all of the companies will what do? They will show up subsidiaries in foreign lands and will show up losses in those foreign countries, so foreign companies, and not pay any UK corporation tax liability. So very simply, any non-UK resident company will not participate in the loss relief. What next? Let's have a look at a quick illustration. Right, so what do we have here? A PLC owns 75% of the ordinary share capital of B Limited and 100% of the ordinary share capital of C Limited. B Limited owns 75% of the ordinary share capital of D Limited. So A owns B, B in turn owns D Limited. Now, so what do we have? There is definitely, so what about 75% ownership is what we need to check, right? A owns 75% of B and more than 75% of C. So definitely A, B and C are forming part of the 75% group. So 75% group, as of now, definitely A, B and C is there. What about D? Does D also form part of the 75% group? B owns 75% of D. What about ownership of A in D? Definitely it is 75% of 75%. So 75% of 75% comes out to be 56.25%, which is less than the required minimum of 75%. Thus, D does not form part of the 75% group. Very simply, why? Because the effective interest of A in D is less than 75%. It is only 56.25%. So, very simply, A, B and C Our 75% group as A has a direct 75% interest in both these subsidiaries. B and D is what? It's a 75% group, as B and D definitely has a 75% ownership in their own right. However, A, B, C and D do not form part of a single 75% group. Why? Because A's effective interest in D is only 56.25%, which is less than the minimum required of 75%. So very simply what it is, that the interest should be, the effective interest of the ultimate parent should be at least 75% in order to form part of the 75% group. What else? Now, what are the principles of group relief? How do I basically set off the losses of one company in the group with respect to the losses, with respect to the profits of the other company in the group? Till now, what we've done the loss reliefs that are available to each of the entities in their own right. Now, in this session today, we'll be doing how losses of one group company can be set off against profits made by the other group company, as long as these companies are a part of the 75% group. So let's have a look at the group relief, which is under section 99, is the relief of losses of a surrendering company. So now what do you have? Losses being incurred by a surrendering company against the profits of one or more of the claimant companies for the corresponding accounting period. So we've done 3 new terms now. Let's have a look at each of these terms one by one. Right. So now till now what do we have? We got P, we got S1, S2, S3, P, S1, S2, S3 all form part of the 75% group. Why? Because the ownership is a minimum of 75%. So let's assume it to be, say, 100%, 75% and another 75%. So all of them effectively have minimum required 75% ownership. Now what happens when one of these entities makes a loss? Supposingly, let's take S1 has made a loss. The company with the loss is known as the surrendering company. Why? Because it is surrendering its loss. The profits of the companies which is going to set off this loss, these companies are known as the claimant company. Why? Because the surrendering company is making a claim on the claimant company in order to set off its losses. So P, S2, S3 are the available claimant companies. Whatever you set off your profits against, losses against the profits of which will be known as the claimant company. What else? Very simply, what do we have? That each of these entities in their own right is a taxable entity. They can have their own losses, they can have their own profits. Apart from the options that we had done till now, which included what? Remember, we had done under section 37 A and B, we had done under section 45, we had done under section 39 as well. So very simply, apart from these, you now also have a group relief which is known as under section 99 relief, under which any of the companies with the loss, which is known as the surrendering company, can set off the profits, can set off the losses against the profits of the claimant company. The only thing required here, the only condition is that we're going to look at the corresponding accounting period. Now, till now we have done one term which is known as the chargeable accounting period, which is known as the cap. Now, cap of the surrendering company, which is S2 in our case, the relevant corresponding period, which means the common time frame between the surrendering company and the claimant company. Supposingly, you are setting it off against the parent company. Whatever is the common area, common time frame is known as the corresponding accounting profits. So very simply, what do we have? Let's try and put some digits to it. Says it's supposing it's 1st of January to 31st of December. The year here starts on the 1st of April and prepares accounts till the 31st of March. So very simply, the corresponding accounting period, the losses of the entire year cannot be offset. Losses of the time frame which matches. So you have to time apportion the losses. Loss multiply by what is the corresponding 9 months. 9 by 12 needs to be time apportioned with the available profits of the entire year. So the profits of the 9 months, which are the common 9 months again. Right? So what do? We correspond, we match the losses of one with the profits of the claimant company, and that is known as the corresponding accounting period, which is very simply the common, where am I? Where is my pen? Right, which is very simply the common time frame between the caps of the surrendering company and the claimant company. So let's have a look at the rules. Right. So once the 75% group is defined, the terms parent and subsidiary are ignored, which means what they are in their own individual stance loses their identity. They are now just known as the surrendering company or the claimant company. They do not exist anymore. They cease to exist as the parent company or the subsidiary company. The loss can be in any of the companies, be it parent, be it subsidiary, can be set off against profits of any of the other company, which may be parent, which may be subsidiary company. So they only become claimant and surrendering companies. They lose their identities as the subsidiary and the holding company. Once the 75% group is defined, the terms parent and subsidiary are ignored. Any company with a loss can be a surrendering company. Also, any other profitable group company can be a claimant company. So, any of these can be surrendering, any of these can be claimant at the same time. So, how do we basically set off these losses? Definitely, what are the losses that you have available? Losses available for surrender are any adjusted trading loss that there be, any unrelieved property business losses that there can be, any unrelieved qualifying charitable donations that there can be. Remember in the previous session what we were doing when we were setting off the losses, when we were claiming a relief, what was happening? The qualifying charitable donations were getting wasted. Now these wasted qualifying charitable donations can be set off against the profits of any other 75% group company. So definitely another loss you're being prevented from being wasted. So any adjusted trading loss, any property business loss, or any unadjusted qualifying charitable donations can be set off. Now what are these profits to start off with? Profits in their own right are total profits of a claimant company after deducting the claimant's own. So what do you reduce? What is profits? Profits of the claimant company is after deducting the claimant's company's own brought forward trading losses, current period trading losses, and any current period charitable donations. Definitely before any setting off any of the losses of the group company, you're going to first set off whatever set of losses you have within your own company. So your own brought forward trading losses, your own current period trading losses, your own current period charitable donations. You're going to first set off. If at all you have any surplus profits left, only then are you going to be able to set off the losses of the surrendering company. Make yourself available as the claimant company. So principles of group relief, very simple as comparison to what we've already done. Corporation tax is a whole lot easier. Your income tax, your capital gains tax was very complicated. Corporation tax, on the other hand, is a very simple topic. Please make sure that you are absolutely well versed with this topic so that you are definitely aiming to get 100% marks in your corporation tax questions. So now the rules, let's begin with the rules. What is the corresponding accounting period, which I just told you is the cap of both the surrendering as well as the claimant company, that is common to both the companies. So the time frame which is common to both these companies is known as the corresponding accounting period. We're not talking about the cap, we're not talking about the chargeable accounting period, but we're talking about the chargeable accounting period. We're talking about the cap that is common to both these claimant as well as the surrendering companies. Now, what is the maximum group relief that any company can basically set off? Definitely for the given corresponding accounting period, it is going to be the lower of the loss of the surrendering company or the profits of the claimant company. Very simply, which means supposingly the loss in the surrendering company is say £10,000, the available profits of the claimant company is £100,000. So definitely you're going to set off what? You're going to set off £10,000 of loss, which is the actual loss that you want to set off. Similarly, what happens when the loss of the surrendering company is say £10,000, but the profits available by the claimant company is say only £4,000. So definitely you can only set off £4,000. Why? Because that is the available profit that is available for you to set off the loss that is there. So always going to be the lower of the two figures. Any amount may be surrendered within this limit. Group relief may be claimed in addition to or instead of any other forms of loss reliefs. Under section 37, 45, 39, terminal loss relief, apart from what we've already done in the previous session, which is available to all of these companies in their own right individually, also available is under section 99, which is known as the group relief. Claim must be made by the claimant company with consent of the claimant surrendering company within 2 years after the end of the relevant cap. So very simply, let's do a quick question on this and be able to understand this a whole lot better. Right. So principles of group relief, A, B, C are 3 companies that form part of a 75% group of loss relief purposes. All companies prepare accounts 31st of March annually. Results for the year ended 31st of March 2017 are, you got in A, you got adjusted profits £300,000. B has made a loss of £200,000. C again has made a profit of £130,000. Property business profits are given, non-trade interest is given, chargeable gains is given, also given is qualifying charitable donations. No company receives any dividends in any other company within the group or otherwise. Company A has an unrelieved trading loss brought forward of £40,000. So definitely you're going to set off this brought forward loss first in line. So let's have a look at what is the loss of B that needs to be set off and what are the available options of profits of A and C against which you can set off these losses. So what do you have required? Identify the losses of B available for group relief purposes. Identify the profits of A and C available to relieve the losses of B. Identify the maximum amounts of group relief available to A and C and state by when they must make their claims. So very simply, what do we have? Let's find out the losses of B that needs to be set off. So B has a trading loss of £200,000. Apart from that, it had some income which is property, business profits you're going to set off, which is £5,000. Also, you have qualifying charitable donations. Donations worth £8,000. So how much in all do you have? Total losses which needs to be set off are loss of trading loss. Right. So 200,000, 3,000 is the amount of loss that you need to set off as that is the loss of B. Now what are you going to set this off? You're going to set this off against the available profits of A and C. So let's have a look at what are the available profits of A and C. Right. So we have A here and we have C here. First, let's start with the trading income. Trading income of A is £300,000. Trading income of C is £130,000. Also, you're going to first set off what? You're going to first set off the brought forward loss, that is relief, under section 45 of A, which is £40,000. Right, so how much of it is there? You now have profits of right. Up next, you're going to also add up other interest that you have, other profits that you have. You have some chargeable gains, non-trade interest. You also have chargeable gains. $20,000 here. And some qualifying charitable donations, which obviously need to be set off. Let's just do a total. Right, out of which you're going to take off charitable donations, which is worth £15,000. So how much of profits do you have now? So the available profits to be available as a claimant company is 290 from A and 121 from C. Very, very simply, how much loss is there? Loss, what is the maximum amount that is going to be set off? Is the lower of the loss. Loss is how much? Loss is minus 203,000, or profits available are 290. So definitely lower of the two is 203 is the maximum that you can claim from A. From C, loss is again the same. Profits, however, are 121. So definitely lower of the two, which is 121. So now amongst these two, that is the maximum set off that there can be. Amongst this maximum set off, any permutation combination, as long as these maximum limits are not being surpassed, can be set off against the loss of 203,000 of A. So supposingly if you're setting off the entire against A, you do not set off anything against C. If you're setting off 121 against C, you can set off the balance against A, or for that matter any permutation combination, as long as these maximum threshold levels are not being surpassed, can be set off as losses. So very simply we know how to set off these losses. Let's get back to the rules now. Right, so now when I am trying to tax plan, what is the objective? How am I going to tax plan my setting off of the losses? The objectives of the planning would definitely be to minimize the group tax relief charge, is to be avoid any unnecessary carry forward of unrelieved losses. So instead of carrying it forward, I would rather just set it off against any of the profits of the group company. Now let's have a look at the examination approach. How you're going to follow the steps, what are you going to follow in order to solve, in order to resolve this planning of the losses amongst the group relief. First thing would be to look at the group structure, identify the companies that belong to the 75% group and that can participate in the group relief. So what do you take out? You could take out any non-UK resident company. So identify your 75% group first and companies which can participate in the group relief. Identify the trading and other losses given in the question. So you have to identify all sorts of losses which have been given to you. Work chronologically, which definitely means you need to work in a sequential manner. First loss gets treated first. The earlier loss gets treated first before any latter loss. Give priority to the losses of relief that can only be relieved in a specific way, which means definitely brought forward trading losses can only be set off against future trading losses. Any capital loss can only be set off against future capital profits. So definitely, because they are very hard and stringent on these, let's set them off first. Also, where a loss can be relieved in several ways, you need to identify the feasible options out of which you're going to choose the maximum limit of group relief for each of the claimant companies. So very simply, just follow these steps, follow this chronological manner, that how we're going to work about in setting off the losses of a surrendering company against the profits of the claimant company. Now let's complicate things a little bit. Till now everything was nice and easy. The books of accounts were being prepared in the same chronological manner. However, what happens when these periods of accounts of this claimant company and the surrendering company are not same, which means we're now going to talk about non-conformous accounting periods, which means that the chargeable accounting period is not the same. In that case, what do? We already know, we look at the corresponding accounting period, which is the common area between the two, and set off the losses of the time apportioned losses against the time apportioned profits of the claimant company, which are, you're going to look at the common time frame between the two. So very simply, how do you set it off? Group relief is given for the corresponding accounting period that is common to both the surrendering company as well as the claimant company. So I'm looking at common time frames. Time apportionment of profits and losses is necessary if the accounting periods of two companies do not fully correspond with each other. In that case, what do we have to look? We have to look at the maximum loss that there can be and the minimum profits that there can be. So I'll have to look at the maximum amount of group relief is the smaller of the two, which is the maximum loss for group relief purposes will be the loss of surrendering companies corresponding accounting period divided by the accounting corresponding period, and the maximum profits of group relief purposes will be the available profits of claimant company multiplied by the corresponding accounting period divided by the accounting period of the claimant company. So very simply, we time apportion the available profits and losses in order to correspond to the common or the corresponding accounting period. Let's quickly understand this with the help of an example. Right. So what do I have here? The surrendering company has year ending starts from the 1st of October, finishes the 30th of September. The claimant company, however, prepares profits from 1st of January to 31st of December. So the losses of the entire company or the entire surrendering company now needs to be split into, how we need to split it into the common time frame, which is October, November, December for year ended 21st of December 2015, and how many months are these? 9 months for the year ended 31st of the year ended 30th of September 2016. So very simply, what am I going to do? I'm going to divide my losses. So now for these 3 months, what do we have? For these 3 months, which is October, November, December 2015, what is the amount of loss that I have? The amount of loss that I have is 24,000 loss is for 12 months. I need to find out the corresponding loss of the 3 months, which comes out to be a loss of £6,000. Now, what is the available profits? Profits in the year ended 31st of December 2015, this company has made profits of £10,000. Now, this 10,000 profits is again for a 12-month period. You only need to time a portion for the relevant 3 months, which comes out to be 2,500. So very simply, lower of the two is going to be 2,500 is what I'm going to set off in the first 3 months. Now let's look at the remaining 9 months. 9 months loss is how much? Similarly, £24,000 multiplied by 12, 9 upon 12, which comes out to be the loss of £18,000. Available profits are how much? 40,000 multiply by 12 divide by how much time frame? Again 9 months, which comes out to be £30,000. So, we're going to take the lower of the two. So, the entire loss of 18,000 can now be set off against the available profits of 30,000 of the claimant company. So, very simply, what have I done? I'm just looking at the relevant corresponding accounting periods between the surrendering company and the claimant company in order to set off losses of the surrendering company against the profits of the claimant company. What else? Let's get back to the rules. Right. So now what happens? Let's complicate things a little more now. What happens when we've got companies which are joining or leaving the group in the middle of the year? So it's very simply, I had A, B, C, D forming part of a group. Company E also joins in, but joins in for after 3 months had expired. So the corresponding period for all of the group definitely becomes the time frame in which all of these companies existed, and when one company leaves, obviously the corresponding period remains till the time all of these companies existed in the group in order to set off the losses. So a corresponding accounting period starts when a company becomes a 75% subsidiary, and a corresponding period finishes or ends when the company leaves the group. So very simply, what do we have? As soon as you join, your corresponding period start. As soon as you leave, your corresponding period finishes. Now for non-conformity accounting periods, similarly, we need to time a portion losses and profits that would be required to be able to set off the losses of the one against the profits of the other. Let's quickly do this with the help of a simple example. Right. Facts as an example 2, accept that the surrendering company now joined the group on the 1st of Feb 2016. So what do we have? This surrendering company joined when? Joined on the 1st of Feb 2016. So what is your corresponding period now? Definitely your corresponding period becomes this time frame, which is now a period of 8 months. So what do? This loss of 24,000 you need to apportion in the 8 months time frame, which becomes how much? Loss becomes 24,000 is the entire year's loss, out of which 8 months are the common 8 months, which becomes loss of 16,000 pounds. Similarly, profits are how much? We have 40,000 profits in the 12 months period, out of which I need to take only the relevant 8 months, which become equals to 26,667, lower of the 2. So 16,000 loss can be set off against the available profits of the claimant company. Also, let's quickly make another variation to it. Facts as an example to accept that the surrendering company left the group on the 31st of August 2016. So let's go back to our question number example 2. Right. Now what it is? The surrendering company left the group on the 31st of, what it is? 31st of August 2016. So somewhere here, the surrendering company left, right? So what do we have? We definitely have, we got the, 31st of August. So we have the same 3 months here as in the first question. In the second part, however, because the surrendering company has left on the 31st of August, how many months do we have? We have a common 8 months only. So what do? This is 31st of August. So we now need to take 8 months out of the 12 months profit which is given, which very simply becomes what? 3 months are the same as in example 2. So how much was that? That was, profits were how much? Losses were how much? Losses were 24,000 multiplied by 3 by 12, which comes out to be 6,000, or profits of, how much is the profit? 10,000 into 3 by 12, which comes out to be 2,500. Lower of the T2, however, what changes is the 8 months time frame. So what do we have here? Losses again with how much? 24,000. We need to take out of the 12 months, we need to take the relevant 8 months, which comes out to be 16,000 pounds, and profits available are now, how much were the profits? 40,000 profits. Out of 12 months, the corresponding months are 8 months, which comes out to be 26,667. So the lower of the 2 is what I'm going to set off my losses again. So very, very simple, very, very methodological, as long as you are only following the common or the corresponding accounting period between the claimant and the surrendering company. Rest everything else remains the same. Let's get back to the rules now. Right. Now that we've done a 75% group, so a gains group I know is what? I just need to start off with the, depends on whether the group comprises a parent company and only directly owned subsidiary companies, which it then becomes a group A, or it also includes, apart from directly owned subsidiaries, it also includes some indirectly owned subsidiaries as well, which would be known as a group B now. Now either of these companies can be a UK resident or a foreign resident company. So very simply, what do I have? Apart from my 75% group, I now am looking at my gains group. Gains group can be of two types. Let's simply open up a workpad, right? Gains group, I know, is of either it can be a group A or it can be a group B. Group A would be what? Group A would be a group which is only consisting of directly owned subsidiaries. Group B consists of when you include both directly as well as indirectly owned subsidiaries. So very simply, I have directly as well as indirectly owned subsidiaries in the gains group. So now how do I basically deal with this? What are the requisite rules for these? What it is, a group A would, how do I set off the gains and the losses in the group? What happens in the gains group? If the group is a group A, the group gains is defined in exactly the same way in which it is a 75% group for a group loss relief purpose. So till now, if it's a group A, it is very much similar to what I already know as a 75% group. The similar way I set off my group relief under section 99. What happens when apart from directly owned subsidiaries, I also have indirectly owned subsidiaries. So if the group is a group B, which is that a gains group only consists of two tests needs to be, the gains group is only going to exist if two tests are going to be satisfied. The first test being that a principal company, that is a parent company of a directly owned subsidiary, must own at least 75% of the ordinary share capital and be entitled to 75% of the assets upon winding up and assets on winding up of the subsidiary company, and also the head of the group, which is the parent company, must own indirectly more than at least 50% of the ordinary shares or the distributable profits upon winding up of each of its subsidiaries. So what do we have now? Let me open up my worksheet. Right, group A is similar to my 75% group. So it only comprises of directly owned subsidiaries. I set off my losses in the form of my 75% group with respect to under section 99. Now, what happens in case of it is a group B? In case it is a group B, what I very simply do is that it would be a group B, it would comprise forming part of a gains group if two conditions are met. The two conditions being holding company and then I have few subsidiaries, directly as well as indirectly owned subsidiaries. So the direct should be at least 75%, and as long as indirect ownership is more than the required 50%, so even if this is 75% of 75%, which is 56.25%, so either indirect ownership is how much? More than 75%. Indirect ownership needs to be at least 50%. Then I can call this as a group B and I can participate in group relief purposes. So very simply, that is what my group B relief is all about. So how do I basically claim it? Now that I know the conditions, what is these gains group? Unlike the 75% group, there can only be one gains group in any of the group of companies. Although any companies in the gains group may be non-resident company, only UK resident companies can participate in tax efficient transactions within the gains group. So very simply, what is happening? I now have a gains group as long as it is a at least against group B group as well, they can participate not in loss reliefs but in intergroup transactions. How they can participate, how it benefits them, let's have a look at these with the help of a simple illustration to start off with. Right. So now what do I have? PPLC owns 75% of the voting ordinary shares of S1 Limited. In turn, S1 owns 75% of voting share capital of S2, and S2 owns 75% of the voting capital of S3. So all companies are UK resident companies, and the ownership agreements have existed for many years. So 75% definitely forms part of group A. What else? What about P1, S1, S2? 75% of 75% is how much? It is 56.25%, which is more than the required 50% indirect. So definitely forms part of my group B. What about S3? Can I also include S3? S3 is 75% of 75%, which comes out to be how much? 42.19%, which is very well less than 50%, does not form part of my gains group. So my group B is only P, S1 and S2. So very simply, I now know what are the groups, what is the group and which can participate in intra-group transfers. Why? Because there is a group B of gains that actually exists. Now let's have a look at how forming part of these groups, how entities within these groups can participate in transferring goods, assets from one entity to the other, from one company to the other. Right. So definitely, what sort of advantage does it bring in through? What form of advantages can I claim is that I can now claim reliefs on my transaction or my transfers of goods from one party to from one group company to the other, as long as I am benefiting, as long as that benefit is there. Very simply, which means when an asset, capital asset, is transferred between companies within the gains group, there is a no gain, no loss disposal. So very simply, when I am transferring assets from one entity to the other within the gains group, it is known as a no gain, no loss disposal. Now, because it's a no gain, no loss disposal, I can effectively transfer my assets from one entity to the other entity without attracting any corporation tax liability. Why? Because it is going to be considered a no gain, no loss disposal. So very simply, what it is a no gain, no loss disposal. On the subsequent dischargeable disposal of the asset by the transferee company, a chargeable gain or an allowable loss is calculated by comparing the open market value with the deemed cost of the transferee. Simply because there is a no gain, no loss, cost of the transferor becomes cost of the transferee. At the time of a intergroup transfer, there is a no gain, no loss. So very simply, this asset gets transferred from one entity to the other without incurring any corporation tax liability. These no gain, no loss rules automatically apply when the group gains exist. So definitely, why? Because it's forming part of a group. So very well, I can now make intra-group transfers without incurring any corporation tax liability. So as long as it is beneficial for me to make an intra-group transfer of assets, I'm going to transfer my assets without attracting any corporation tax liability. Let's have a quick look at an example for this. Right. So what do I have now? GPLC owns 80% of FPLC, and both companies prepare accounts to 31st of March each year. So what do I have? I've got GPLC, which owns 80% of FPLC, both of them prepare accounts 21st of March. On 20th of Feb 2005, GPLC bought a land costing. So cost of land is £124,000. GPLC transferred the land to FPLC on 15th of July 2010 when the market value was £159,000. Now when G is making a transfer within the group, what it is a no gain, no loss disposal, which means that this market value has only been given to confuse you. It is actually irrelevant in the question. Why? Because the asset is going to be transferred from G to F at a no gain, no loss disposal. So what happens? Very simply, the cost for GPLC becomes the cost of the same asset for FPLC. Now, when FPLC sold this piece of land to a third party on the 8th of July for 296,000, that is when there is going to be an actual gain or loss arising on the transfer. That is a transfer which is going to be subject to corporation tax. Assume the following indexation factors is given to us. So what it is, very, very simply, what am I going to do? What happens first when there is a transfer from GPLC to FPLC? That is on, when is the transfer happening? 15th of July 2010. Very simply, cost of GPLC becomes the cost of FPLC. However, because companies are included, we need to bring it up to the most relevant time frame. We need to index the cost which is given to us. So the cost is how much? Cost is £124,000. Just bring it up, index it further. £124,000 multiplied by the indexation allowance, which is 0. From July, I'm going to bring it up to the most relevant cost, which is going to be what? Which is going to be 0.179. It is given to me 179, which simply just becomes how much? 22196. So now my cost becomes 146,196. This is the deemed cost of the asset for FPLC, which now subsequently sells of the asset on the 8th of July 2016. Let's have a look at what happens on the subsequent sale of the asset. Now when FPLC sells to third party, that is when a chargeable gain is going to arise. My proceeds are what? Proceeds are 296,000. I'm going to compare it with the cost, which is now 146,196. I also need to index my cost, which now again becomes how much? This cost needs to be brought up to the most relevant cost, which is 146,196 multiplied by the indexation allowance 0.177, comes out to be how much? 25877, thus making a gain of 123,927 pounds. So very simply, what it is, that transfers within the company, within the gains group, are what? They are basically, they are not in effect, they are not an actual transfer. They are considered as a no gain, no loss transfer. Let's get back to the rules. Now, how can I basically make use of these transfers? The no gain, no loss rule can be used advantageously to realize capital gains and losses in the same company so that the immediate loss relief is obtained. Definitely, loss of one company can be relieved against the profits of the other company. So definitely the most relevant, the most immediate loss relief is available. Also, this avoids the situation in which a realized capital loss may be carried forward unutilized in one company, where unrelieved gains are taxable in another. So very simply, if one has gains, one has unrelieved losses, you can set it off without having to carry forward it to the next year. In the very same year itself, you can set it off. Now, one very important advantage of these intra-group transfers that are no gain, no loss disposal is that companies can transfer assets from one entity to the other without actually physically transferring the goods, which very simply means, let's get back to our same question, GPLC transferred to FPLC in the question, right? Now, without having physically transferred the goods, you can just make a notional transfer. That is, you can assume that an intra-group transfer took place. Thus, it was a no gain, no loss disposal. So you need not basically look at whether or not these losses can be set off against the other or not. So very, very simply, notional transfers are what? Notional transfers are that instead of physically transferring the good, I can assume that yes, the good was transferred, which means that even if GPLC had sold it off to the third party, if it becomes advantageous to the group as a whole to show that instead of GPLC, the asset was first notionally transferred, notional intra-group transfer from G to F, and then F is the one which actually sold it off to the third party. Yes, definitely, yes, I can assume it. Now come to think of it, why do you think as a group would it be advantageous for me to make this notional intra-group transfer? Remember your rollover reliefs? Let me just erase this and show you how it becomes advantageous for companies to claim these notional intra-group transfers. Now what do we have? We've got GPLC and FPLC forming part of a gains group as of now. What happens? GPLC actually sold off the asset to a third party. Instead of the sale of the asset, it definitely got some proceeds. Now it did not reinvest these proceeds anywhere. However, on the other hand, FPLC had reinvested, had basically bought a qualifying business asset. So GPLC sold a qualifying business asset and FPLC bought a qualifying business asset. Because GPLC sold a qualifying business asset, definitely they should be subject to corporation tax, right? But now what do? Instead of showing that GPLC had transferred the asset to the third party, we first assume that there was a notional intra-group transfer of the asset from GPLC to FPLC, and then FPLC is the one which had actually sold off the assets to the third party. Now what it is that we are assuming that FPLC sold a qualifying business asset and it also bought a qualifying business asset. Thus, FPLC now becomes eligible to claim what? Becomes eligible to claim a rollover relief and thus defer the payment of corporation tax. So instead of now being liable to pay tax, I have assumed a notional transfer, thus claimed a rollover relief and thus deferred my corporation tax liability. Why? Because I was forming part of a gains group. So very, very simply, that is what is the advantage of forming part of a group. So notional intra-group transfers of assets mean tax benefit of the no gain, no loss disposal provisions can be obtained without actually making a gain or loss actually within the group. Under the notional transfer rules, an asset can be sold by any gains group company and provided a claim is made within 2 years of the end of the cap in which the asset was disposed of outside the group can decide retrospectively which company was deemed to have made the chargeable disposal. So even after 2 years, I can go back in time, make a twisting of my assets, that I can twist the assets from being notionally transferred from GPLC to FPLC, and then FPLC having subsequently reinvested the assets into another qualifying business asset, thus eligible for rollover relief. What are the advantages of it? The apparent advantages of it is that the planning can be done retrospectively, and thus the outcome is definitely an assured outcome. The election can be applied to the whole or part of the asset, which means I need not transfer 100% of the asset. I can also transfer a part of the asset. The transaction cost of actually transferring ownership within the groups are avoided. Why? Because there is only a notional transfer, which is not an actual transfer. So very simply, I'm not actually transferring assets, but I'm making a notional transfer from one party to the other entity within the gains group. Also, what about rollover relief? All companies in a gains group are deemed to conduct a single trade for the purpose of rollover relief. This extended application of rollover relief means that a chargeable gain can be deferred without obliging the same company to make an appropriate reinvestment. Special conditions for applying rollover relief exist, which are that each company must be a member of the group gains at the relevant time, although they need not be both members on the occasion of the asset sale and purchase. But when they are claiming, that is when both the companies, the claimant as well as the surrendering company, must be part of the gains group. The relief is not available if the asset purchased was previously owned by another member of the same group. So very simply, what do you have? In order to claim this rollover relief, you need to actually buy a qualifying business asset from another third party, not within the gains group, and the qualifying, the sold asset must be sold to a genuine third party and reinvested into buying another qualifying business asset. That is when entities can defer their tax payment and claim a rollover relief. So that's it. We've done quite a lot. We've finished off our corporation tax liability with respect to all the rules for corporation tax. We started off with what is the corporation tax liability, how they are calculated in entities in their own premises, how losses within each group, within each party, within each company are set off, and then today we've done how these losses, how these corporation tax rules work when these companies form part of a group of companies, be it a 75% group or be a gains group, which is either a group A or a group B, but forming part of a gains group. So definitely corporation tax a whole lot easier than your income tax and your corporation tax and your chargeable gains tax. So make sure you're doing lots and lots of practice on this topic. Apart from the questions we've done in this session, make sure you're doing lots of question practice at home as well. Any doubts you have, as usual, you can always email it to me at Shilpi ACCA@gmail.com. That's it. Thank you very much for today's session, and thank you.